Welcome to the Deep Dive. Today, we're unpacking the latest earnings call from NetApp, a major player in data storage and management. We've waded through the transcript, the numbers, all the commentary, and our job here is to pull out the key stuff for you. What are the main takeaways? What trends are popping up? Any surprises? Basically giving you the quick download on what's happening with them and the overall feel. Well, management sounds pretty upbeat about their own performance, their strategy, but definitely cautious about the bigger picture, the economy overall.
That's right. It's a bit of a split message, isn't it? Strong execution, but keeping an eye on the horizon. We'll hit the main results first, then dig into, what's actually driving the business. Definitely need to talk about enterprise AI. That's a huge theme. And then we'll cover the financial health, the outlook they gave, and maybe try to understand that caution a bit more.
Okay, perfect. So let's jump right in with the numbers. The headline figures for Q4 and the full fiscal year 25. What did they report?
Okay, yeah, results were definitely strong on the surface.
Yeah.
Q4 revenue hit $1.73 billion, and billings were even higher, $2.03 billion.
And how does that compare year over year?
Both up. Revenue grew 4% compared to last year's Q4, and billings were up a solid 12%. And what's really notable here is this makes it 6 quarters in a row.
6 quarters.
6 consecutive quarters of year-over-year growth in both revenue and billings. So there's some real consistency there.
Okay, that's momentum. And the full year, FY25.
Full year was also strong. Record revenue, actually. $6.57 billion, which is up 5% from the previous year. And record billings, too, $6.78 billion, up 8% year over year.
Record revenue, record billings, consistent growth.
Yeah.
Sounds good. How did that translate to profit, the bottom line?
Yeah, that's where it gets interesting, too. They hit all-time highs for the fiscal year in gross profit, operating margin, and earnings per share, EPS. Operating margin for FY25 landed at 28.3%.
28.3%, how good is that?
That's really healthy. It's up 150 basis points. That's 1.5 percentage points compared to FY24. And EPS, earnings per share, also saw strong growth, up 12% for the full year compared to last year.
So growing the top line, but profits are growing even faster. What does that tell you about how they're running the business?
It points to really disciplined execution, I think. Especially given the unpredictable market environment we're still in. The fact that they grew revenue 5% for the year, but kept their operating expenses pretty much flat, that shows really good operating leverage.
Right, getting more profit out of each dollar of revenue.
Exactly. The business model seems pretty efficient right now at converting that top-line growth into bottom-line results.
Okay, so strong numbers overall. Let's get into the why. What's actually driving this? What are the growth engines?
Management really focused on 2 main areas fueling this growth. First, all-flash storage. Second, their public cloud services.
All right, all flash. We hear that term constantly. Faster storage, no spinning disks. What's the story for NetApp here? Is it a big part of their business?
Oh, it's huge and getting bigger. They've got really strong momentum. Their annualized revenue run rate, basically the Q4 revenue times 4 for all flash, hit a record $4.1 billion at the end of the quarter.
4.1 billion run rate and growing.
Yep, up a strong 14% year over year.
Right.
And it's becoming much more central to their core hybrid cloud business. It made up about 2/3 of that segment's revenue in Q4.
2/3, wow.
And look at the adoption rate within their customer base. They said 44% of the systems they support are now all flash. That was only 38% a year ago. So customers are definitely making that transition.
Okay, growing fast, becoming core, customers are adopting. You mentioned market share gains too. How are they doing against competitors?
This is a strong point they made. According to IDC data for calendar 2024, they gained almost 300 basis points of share in the overall all-flash market.
300 basis points, that's nearly 3% market share gain.
Exactly. And they said that was more than any other vendor gained. So clearly taking share. In the specific block storage part of the market where they've been focusing, they gained nearly 100 basis points, again, per IDC.
Any examples of that in action? Customer wins?
Yeah, they gave a good one.
Yeah.
Big life sciences company.
Sure.
In Q4, this company basically ripped out a competitor's entire 10 petabyte storage setup.
10 petabytes, that's massive.
Huge. And replaced it all with NetApp's all-flash solution. The goal was simplifying things, bringing different data types, different performance needs, all under one roof. A clear competitive displacement.
Wow, okay, that 300 basis point gain and the 10 PB win really drive home the momentum there. What about the second engine, public cloud services?
Yeah, this area has actually been accelerating for them, especially after they strategically divested a piece called Spot and sharpened their focus. So the overall segment grew 22% year over year in Q4, But if you take Spot out,
which they sold off.
right, if you exclude Spot, their core cloud storage services, the stuff they offer directly or through marketplaces like AWS or Azure that grew an even faster 44% year over year in Q4.
44%. Okay, so focusing the portfolio clearly paid off there.
Definitely. And those core services now make up about 3/4 of that segment's revenue, excluding Spot. So the growth is concentrated in the area they're prioritizing.
Any customer examples for the cloud side?
Yep. They mentioned a SaaS provider, software as a service company, needed really high performance multi-protocol storage right in the cloud. They were looking for better cost efficiency and resilience than what they had. They moved over to AWS FSx for NetApp on NTAP in Q4.
And it worked out?
Apparently, yes. They found it was more cost effective, gave them that unified environment they needed, and better availability. So a good win showing the value prop in the cloud.
And what about Keystone? That's their own sort of storage as a service offering, right? Did that play a role?
It did. They specifically called out Keystone momentum as helping drive their professional services revenue, which was up 13% year over year in Q4. And the Keystone sales numbers themselves look strong. The total contract value, or TCV, signed in FY25, was $224 million.
Okay, TCV. How does that compare?
That was up 54% compared to the previous year. So big jump in contract signings. And another indicator, unbilled remaining performance obligations, basically future revenue locked in from Keystone deals that grew 23% just from Q3 to Q4, hitting $430 million. That points to a nice pipeline of future revenue.
Okay, now, here's where I think it gets really interesting. Enterprise AI, it feels like every company is talking about it. How is NetApp fitting into this massive shift? Are they actually seeing business from it?
Yeah, they see AI as a huge opportunity, but also something that really highlights the problems with older ways of managing data. AI models need access to just vast amounts of data, right? Often scattered everywhere, on-prem, multiple clouds, different formats. Legacy storage just wasn't designed for that kind of unified access.
So NetApp pitches their hybrid multi-cloud approach as the answer.
Exactly. They position it as the way organizations can actually harness all that scattered data simply, securely, sustainably, specifically to fuel their AI initiatives.
Okay, that's the pitch. Is it translating into real deals, actual revenue?
This was maybe the most striking number on the call. Their AI-related business grew fivefold year over year in Q4.
Fivefold, seriously.
Fivefold. Now, it's likely starting from a smaller base, but still, that's explosive growth, not just ticking up slightly. And they closed around 150 deals specifically tied to AI infrastructure or modernizing data lakes for AI in Q4 alone.
150 deals in one quarter.
Yeah, across different regions, different industries, different specific AI uses. It really shows that companies are moving past just experimenting with AI and are now building out the actual infrastructure needed. There's real urgency.
That fivefold growth in the deal volume certainly suggests urgency. Who are they partnering with to make this happen? The AI ecosystem is complex.
Right. They emphasize their expanding partnerships. They work very closely with NVIDIA, for instance. Their storage is certified for NVIDIA's DGX Super POD AI systems. They also partner with the big cloud providers, the hyperscalers, and other AI platform companies like Domino Data Lab. They mentioned creating specific reference architecture, sort of pre-validated blueprints with partners like Cisco and Lenovo too. Makes it easier for customers to deploy.
Okay, so they're plugged into the ecosystem. What's their unique angle, though, their specific value in AI?
A really key point they hammered home was enabling AI on data in place. Think about it. Enterprises have petabytes, exabytes maybe, of valuable data already sitting in various systems.
Right. Moving all that is a nightmare.
Exactly. It's incredibly complex, expensive, time-consuming. NetApp's technology is designed to let customers prepare and use that data for AI without having to migrate it all first. Leveraging that huge installed base of unstructured data where it sits is a massive advantage they believe they offer.
That in-place capability sounds crucial for big companies. What about the different phases of AI? Training models versus actually using them, the inferencing part.
Yeah, management thinks fiscal 26, the year they're in now, will be pivotal for enterprise AI storage. And they specifically called out AI inferencing.
That's using the trained model, right?
Right, using the model to analyze new data, make predictions, power applications. They think the storage opportunity for inferencing in the enterprise could actually end up being much larger than the opportunity for just training the models.
Interesting. Why is that?
Well, inferencing often needs very fast access to large, constantly changing data sets to deliver real-time results. That plays right into the need for high-performance, scalable storage infrastructure like theirs.
Got it. Any customer stories that illustrate this AI adoption?
Yes, they shared one about a large telco in Asia. This provider chose NetApp for their whole AI strategy. They needed a cloud setup for model training and a separate, larger on-prem cluster to offer generative AI as a service to their customers.
So using NetApp across both environments.
Exactly. It allowed them to optimize performance and cost, but also integrate the training pipeline smoothly with the actual AI service delivery. They mentioned other use cases too, modernizing data infrastructure like data lakes for AI, supporting national AI centers, internal AI factories at large companies, and even cloud service providers using NetApp to host inferencing for others.
Okay, it's definitely clear AI is moving out of the lab and driving real demand for this kind of modern data plumbing. Let's switch gears a bit. Financial health and the outlook for the year ahead, how's the balance sheet look?
Pretty solid. They ended the fiscal year FY25 with about $610 million in net cash. That's $3.85 billion in cash and investments minus $3.24 billion in debt. And they mentioned they plan to use about $750 million of that cash this month in June to pay off some maturing debt notes.
Okay, comfortable cash position. And cash generation, how's the cash flow?
Q4 was strong. $675 million in operating cash flow. $640 million in free cash flow. They said that was helped by better collections and lower supply chain payments. For the full year, FY25 operating cash flow was $1.51 billion, free cash flow $1.34 billion. Those full year figures were actually down a bit from the prior year, mostly due to working capital shifts, they said.
And shareholder returns, buybacks, dividends, what are they doing there?
Very active. In Q4 alone, they returned $355 million to shareholders, about $250 million through share buybacks and $115 million in dividends. They also just got authorization to buy back an additional $1.1 billion worth of shares. And importantly, they stated their intention for this current fiscal year, FY26, is to return up to 100% of their free cash flow to shareholders.
Up to 100% of free cash flow back to shareholders. That's a strong commitment. Okay, so solid footing financially. Now, looking ahead to FY26, what's the guidance? What's the outlook?
Yeah, this is where that note of caution really comes in, despite the strong finish to FY25. For the full fiscal year 26, they're guiding revenue between $6.625 billion and $6.875 billion. Midpoint there is $6.75 billion.
And how does that compare to the year they just finished?
Well, they reported it as about 3% growth year over year. But they were quick to point out that if you exclude the revenue from that spot business they sold, which was about $95 million a year, the midpoint actually implies growth closer to 4% year over year.
Okay. So XSpot, it's more like 4% growth for the full year, similar to FY25's growth.
Yeah.
Got it. What about margins and EPS for FY26?
Guidance there is for consolidated gross margin between 71 and 72% and operating margin between 28.8 and 29.8%. They do expect product and cloud margins to dip a bit here in Q1, the current quarter, before gradually improving through the year. And the EPS guide for FY26 is $7.60 to $7.90, midpoint $7.75.
Okay. But you mentioned Q1 might be weaker. What's the specific guidance for the immediate next quarter?
Yeah, Q1 guidance definitely reflects more caution. The revenue midpoint they gave is $1.53 billion. That's actually down about 1% year over year on a reported basis.
Down 1% after 6 quarters of growth.
Exactly. Now, if you exclude Spot again, it implies about 1% growth year over year for Q1, but still, that's a significant slowdown from the 4% they just posted in Q4.
And margins in Q1?
Also expected to be lower, like I said. Operating margin guide for Q1 is 25 to 26% before it starts climbing back up later in the year.
Okay, so the results were strong, but that near-term Q1 outlook is definitely tempered. What's driving that caution? What are they seeing out there in the market?
They talked quite a bit about mixed signals from the global macro environment. You know, a general growth slowdown, lingering inflation worries, just high uncertainty overall. They expect customers to remain cautious with spending. They specifically called out ongoing friction in the U.S. public sector, think government budget cycles, potential delays, and also headwinds in parts of Europe, the Middle East, and Africa. Things like trade policy uncertainty, tariffs. They mentioned that impacting manufacturing economies, especially in Europe, making companies hesitant on big IT spends.
Right, the tariff situation. Did they quantify the impact?
They said the direct impact on their gross margins is pretty small, maybe 40 to 60 basis points. But the bigger issue, they stressed, isn't the direct cost itself.
It's the uncertainty.
Exactly. It's the uncertainty created by all these geopolitical and trade tensions. That uncertainty makes enterprises, particularly for larger deals, slow down their decision-making. They just don't have visibility on when things might resolve, so they're building that prudence into the near-term forecast.
That makes sense. Uncertainty freezes big decisions. I bet the analysts on the call really dug into that gap, the strong performance versus the cautious outlook. What came out of the Q&A?
Yeah, the Q&A was definitely focused on squaring that circle. Management basically said their confidence in growth accelerating later in FY26 after that soft Q1 comes from a few things. One, confidence in closing some of those large AI and data modernization deals they see in the pipeline. Two, the impact of sales capacity they added late last year kicking in. And three, just the underlying strength they still see in their cloud and all-flash businesses.
Okay. And what about that Q1 margin dip? Did they explain that further?
They just reiterated that product margin should bottom out in Q1 and then improve. And they highlighted again that the public cloud growth acceleration is helped by that mix shift towards the high-growth first-party services, ones growing at 44%.
How are they feeling competitively, especially with all-flash growing fast, and maybe the whole Broadcom VMware situation that's shaking things up?
Competitively, they seem confident. In all-flash, they pointed out their 14% growth significantly outpaced the overall market, which IDC said slowed to maybe 9%. They still think this shift away from traditional spinning disks is relatively early innings, like third or fourth inning was the phrase used. They expect to at least keep pace with the market in FY26.
And the VMware impact.
Interesting comments there. They said they're seeing increased customer caution around hyperconverged infrastructure, HCI, because of the Broadcom changes. That potentially opens doors for NetApp's traditional storage. They're also adding support for alternative virtualization platforms and seeing growth in cloud-based VMware services that actually run on NetApp infrastructure underneath. So finding opportunities amidst the disruption.
So the message is, competitive position is strong, especially in AI. The caution is purely macro-geopolitical, not about losing deals.
That was definitely the message, yeah.
Did they say if things suddenly fell off a cliff at the end of Q4, was the caution due to a bad end to the quarter?
No, they said Q4 played out pretty typically in terms of linearity. The caution isn't from a sudden drop-off. It's more about the ongoing challenge of predicting the timing for closing those bigger deals, because they're sensitive to those external factors.
Okay. And looking even further out, beyond this year, what's the real long-term potential they see from AI?
They sort of framed it as dependent on the next 12, 18 months. They believe the longer-term growth, say FY27 and beyond, hinges on enterprises starting to see real, tangible business value from deploying AI inferencing and maybe more advanced agentic AI apps. But they feel the crucial data infrastructure foundation is being laid right now, which positions them well whenever that broader value realization really takes off.
Right. So this deep dive really paints a complex picture, doesn't it? A company firing on cylinders operationally, gaining share, positioned for a huge trend like AI, but also dealing head-on with global economic uncertainty that's making customers tap the brakes, at least in the short term. Okay, let's shift gears slightly. Time for the part where we connect some dots, maybe think a little creatively. And remember, folks, this is absolutely not financial advice. Just a thought experiment based on what we heard in the earnings call material.
Right. Disclaimer firmly in place. So based on this dive, especially that five-fold jump in AI business year over year in Q4, and management's pretty strong conviction that this current year, FY26, is going to be really important for AI inferencing adoption. Well, here's an outrageous but maybe plausible idea. Management sounds very confident that those big AI deals in their pipeline will close later this year, driving that growth acceleration after the slow Q1. What if the market right now is so focused on the macro headwinds they talked about, the tariffs, Europe's slowing U.S. government stuff, that it's actually underestimating the potential impact of this AI growth kicking in later?
So the idea is the market might be missing the AI upside because it's distracted by the near-term gloom.
Potentially. So the thought experiment is, could you construct a scenario, maybe a targeted bet, on NetApp's stock price accelerating significantly if and when those large AI inferencing deals actually get announced and start hitting the books later in the fiscal year? That kind of trigger could make the market suddenly reevaluate and price in a much higher, longer-term AI growth story for them. Maybe it involves something like longer-dated call options, or even a pair trade long NetApp, short a competitor perhaps seen as less ready for this AI data infrastructure wave.
Again, purely illustrative. Connecting dots from the call. Highly speculative, involves significant risk, depends entirely on those deals actually landing and the market reacting in a specific way.
Absolutely. Just an example of thinking through the narrative and potential market interpretations. So to quickly wrap up the key takeaways from digging into this NetApp material, record FY25 performance, definitely. driven by solid execution, share gains in all-flash, and accelerating growth in their focused public cloud services. They're clearly positioning themselves strategically for enterprise AI, seeing that explosive early growth, particularly around inferencing and enabling data in place. Financial health looks solid. The FY26 outlook is cautious, yes, reflecting real macro uncertainty hitting deal timing. But underneath that caution, there's also confidence in their strategy and pipeline to capture growth, especially from those larger AI deals expected later in the year.
Yeah, I think the main takeaway for you, the listener, is that NetApp sees itself navigating this patch of uncertainty with a strong portfolio and competitive stance. They believe they're lined up with huge IT priorities like data modernization and, crucially, the infrastructure needed for enterprise AI. It feels like they think they're at an inflection point if the economy cooperates. We really appreciate you joining us for this deep dive into the NetApp earnings call. And here's a final thought to chew on as you process all this. Considering that clear tension between the near-term caution they expressed and that strong conviction in longer-term AI-driven acceleration, how do you weigh those forces, that balance between current headwinds and future potential? Something to mull over.